Should you focus on paying down your mortgage or investing your money? This is a question many homeowners grapple with. It's a conundrum, a crossroads of financial decision-making, if you will. On one hand, we have the path of paying down your mortgage, freeing yourself from the chains of debt. On the other, there's the allure of investing, the promise of future wealth and prosperity. Two different roads, two different outcomes. Today, we will deeply dive into these two options and help you make an informed choice. First, let's understand what paying down the mortgage means. It's a term you've probably heard before, maybe in passing or in a casual conversation about homeownership. But what does it really entail? Well, to simplify, paying down the mortgage is a process of making extra payments on your mortgage loan, above and beyond your regular monthly payments. These additional payments go directly towards reducing the principal amount of the loan, which is the original amount you borrowed to purchase your home. Now, why is this important? The answer lies in the way mortgage loans work. When you take out a mortgage, you don't just pay back the amount you borrowed. You also pay interest, a percentage of the loan charged by the lender for the privilege of borrowing their money. This interest is calculated on the outstanding principal amount. So, the more of that principal you can pay off, the less interest you'll be charged in the future. Think of it like a snowball rolling down a hill. The more snow it picks up, the bigger it becomes, right? Similarly, the more you reduce your principal, the smaller your interest payments become, which means you're saving money that would otherwise be spent on interest. And here's the cherry on top. The faster you pay down your mortgage, the sooner you'll be free of your loan. Imagine what it would feel like to own your home outright, with no monthly mortgage payments to worry about. It's a goal that many homeowners aspire to. But wait, there's more. When you pay down your mortgage, you're also building equity in your home. Equity is the difference between what your home is worth and how much you owe on it. The more equity you have, the more financial flexibility you have, whether you want to sell your home, refinance, or borrow against your home's value. So, paying down your mortgage can save you money in the long run, but what about investing? That's a great question, and it's the topic we'll dive into next. So, stay tuned. Paying down your mortgage can offer several benefits. Consider this: you're in the midst of a storm, the wind is howling, the rain is pounding, and there's a leak in your roof. But you're not worried. You know that you own your home outright. There's a sense of security and peace of mind that comes with knowing your home is truly yours. And that's one of the significant benefits of paying down your mortgage. Now let's talk numbers, shall we? When you pay down your mortgage ahead of schedule, you're effectively reducing the total amount of interest you'll pay over the life of your loan. That's because most mortgages are set up so that you pay more interest than principal in the early years. So every extra dollar you put toward your principal represents a dollar less you'll pay in interest down the line. This can result in substantial savings over time. Moreover, paying down your mortgage faster increases your home equity, which is the portion of your property that you truly own. This increased equity can provide you with more financial flexibility. For instance, if an unexpected expense comes up, you might be able to tap into this equity for a loan. Or if you decide to sell, having more equity means you'll walk away with more money in your pocket. And let's not forget about the psychological benefits. Imagine the feeling of making your final mortgage payment, knowing that your home is completely paid off. There's a sense of accomplishment and freedom that comes from being mortgage-free. It's like having a huge weight lifted off your shoulders. However, it's also important to remember that the benefits of paying down your mortgage don't exist in a vacuum. There are other financial considerations to take into account, like your other debts, your income stability, and your retirement savings. While these benefits are appealing, they are not the only factors to consider. It's crucial to weigh all the pros and cons and perhaps seek advice from a financial advisor before deciding whether paying down your mortgage is the right move for you. After all, personal finance is just that, personal. Despite the benefits, there are also drawbacks to paying down your mortgage. First and foremost, paying down your mortgage can result in less liquidity. Liquidity refers to the ability to quickly convert assets into cash. When you put your funds towards your mortgage, you're essentially locking that money into your home. While this can be beneficial in the sense of building equity, it also means you have less cash on hand for unexpected expenses or opportunities that may arise. This leads us to the second drawback: potential missed investment opportunities. The money you put towards your mortgage is money that could have been invested elsewhere. For example, you might have the opportunity to invest in a promising startup, or perhaps the stock market is particularly favorable. However, if a significant portion of your income is tied up in your mortgage, you may not have the financial flexibility to take advantage of these opportunities. The third drawback is the possibility of not getting a better return on your money. While paying off your mortgage gives you a guaranteed return in the form of interest savings, the rate of return is usually lower than what you could potentially earn from investments. For instance, if your mortgage interest rate is 3%, but you could earn 7% from an investment, you're missing out on that extra 4% return. It's also worth noting that while mortgage interest is often tax deductible, the benefits of this deduction can be offset by the lost opportunity to invest. And in some cases, the tax savings from the mortgage interest deduction might not be as much as you think, particularly if you're in a lower tax bracket. In conclusion, while paying down your mortgage can certainly have its advantages, it's important to consider the potential drawbacks. Every financial decision has its trade-offs, and understanding these can help you make the best decision for your unique financial situation. Balancing these pros and cons can be challenging. Now let's shift our focus to investing. Now let's delve into the world of investing. Investing in its simplest form is the act of allocating resources, usually money, with the expectation of generating an income or profit. It's about making your money work for you, even while you sleep. Instead of letting your hard-earned cash sit idle in a checking account, you put it into something that has the potential to grow or yield returns over time. There's a myriad of investment options available, each with its own potential for return and level of risk. Let's start with stocks, one of the most popular forms of investment. When you buy a company's stock, you're buying a piece of that company, becoming a partial owner. If the company does well, the value of your stock can increase, and you might receive dividends, which are a portion of the company's profits distributed to shareholders. Bonds are another type of investment. When you purchase a bond, you're essentially lending money to a government or corporation. In return, they agree to pay you back with interest after a certain period. Bonds are typically considered less risky than stocks, though the potential returns may also be lower. Real estate investment is another avenue. This involves buying property with the intention of generating income, either through rental income or the future resale of the property. Mutual funds, index funds, and exchange-traded funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. They offer instant diversification and professional management, but come with their own set of fees and considerations. Then there's the potential for higher returns. Investing can lead to substantial growth of your wealth over time, thanks to the power of compound interest. This is the process where the interest you earn on your investment begins to earn its own interest, leading to exponential growth over time. However, it's essential to remember that investing isn't a guaranteed way to get rich quick. It comes with risks, and the potential for higher returns usually means a higher level of risk. But with careful planning and informed decision-making, investing can be a powerful tool for wealth creation. Investing can be a powerful tool for wealth creation, but it's not without its risks. Investing your money can offer several advantages. And today, we're going to dive into some of these benefits. First up, the potential for higher returns. You see, when you invest, you're not just putting your money in a safe box waiting for you to use it. No, you're putting your money to work. Depending on the type of investment, your money could be used by businesses to grow and expand, or it could be lent to governments to fund their projects. And for the use of your money, these entities will give you a return, often much higher than what you'd get if you just left your money in a savings account. Next, let's talk about the growth of wealth over time. Now, this doesn't happen overnight. It's not a get-rich-quick scheme. Instead, investing is a long game. It's about growing your wealth steadily over time. This is where the magic of compounding comes into play. Imagine you have a snowball at the top of a hill. As you roll it down, it gathers more snow and gets bigger. That's how compounding works. The returns you earn on your investments are like the snow that the snowball picks up. The more it rolls down the hill, the bigger it gets. The longer you keep your money invested, the more time it has to grow. And finally, the power of compounding. This is the process where the returns you earn on your investment start to earn returns themselves. It's the snowball effect we just talked about. It's what makes investing truly powerful. Over time, the effect of compounding can turn even small regular investments into a sizable nest egg. However, as with any financial decision, investing also has its downsides, but before we get into those, it's important to understand that the potential benefits of investing can make it a worthwhile endeavor for those who are prepared to take on the risks. And the earlier you start, the longer you can reap the rewards. So why not start today? While investing can be lucrative, it's not without its risks. Now that's a statement that rings true for anyone who has ever ventured into the world of investments. So let's dive right in and unravel the potential drawbacks of investing. The first, and perhaps the most significant disadvantage, is the risk of market volatility. The financial markets are a roller coaster ride. One day, you might be riding high on a profitable wave, and the next, you could be tumbling down into the depths of a financial downturn. The unpredictability of the market is a constant stressor and can lead to substantial losses if you're not careful. Next, let's talk about the potential loss of investment. When you invest, you're essentially gambling with your money. Sure, you might hit the jackpot and become the next Warren Buffett, but there's also a chance, however small, that you could lose it all. Unlike paying down a mortgage, which guarantees a return in the form of home equity, investing comes with no such guarantee. Lastly, investing requires a significant amount of financial knowledge and discipline. It's not just about picking stocks or real estate properties at random. You need to understand market trends, financial statements, and various investment strategies. Moreover, discipline is critical when it comes to investing. You need to stick to your investment plan, even when the market is tempting you with seemingly lucrative opportunities. But let's not forget, with higher risk comes the potential for higher reward. Yes, investing can be risky, but it also offers the opportunity for significant financial growth that you might not achieve by simply paying down your mortgage. As you can see, both options have their pros and cons, and the best choice depends on various factors. It's all about weighing these factors against your personal financial situation, goals, and risk tolerance. So, take your time, do your homework, and make the decision that feels right for you. Remember, there's no one-size-fits-all approach when it comes to your financial journey. So, should you pay down your mortgage or invest your money? The answer isn't as straightforward as you might think. Let's take a moment to recap what we've discussed today. We began by exploring the concept of paying down the mortgage. It's a straightforward approach to homeownership that involves making regular payments to reduce the principal amount of your loan, thereby owning a larger piece of your property outright. This strategy has several benefits, including the peace of mind that comes with reducing debt, the potential for increased home equity, and the promise of a debt-free future. However, it's not without its drawbacks, such as the possibility of tying up too much of your wealth in a single asset or missing out on potentially higher returns elsewhere. Then we dove into the world of investing. This is where you take your money and put it to work in the hopes of growing it over time. The benefits of investing include the potential for higher returns, especially in a strong market, and the opportunity to build wealth over time. But like all financial strategies, investing also has its risks. The market can be volatile, and there's always the chance you could lose money. The choice between paying down your mortgage and investing your money isn't a one-size-fits-all decision. It depends on a variety of factors, including your financial situation, your long-term goals, your risk tolerance, and current market conditions. If you're someone who values security and predictability, paying down your mortgage might be the right choice for you. It's a guaranteed return on your money and can provide a sense of financial freedom. On the other hand, if you're comfortable with a bit of risk and have a longer time horizon, investing could potentially offer higher returns. But remember, it's essential to have a diversified portfolio and not to put all your eggs in one basket. It's also worth considering a hybrid approach. This could involve paying extra towards your mortgage while also investing a portion of your income. This way, you're both reducing debt and building wealth simultaneously. The bottom line is to make informed decisions that align with your financial goals and comfort level. After all, the best financial plan is the one you can stick to. It's about finding the right balance that works for you, taking into account your unique circumstances and aspirations. Remember, whether you choose to pay down your mortgage, invest, or a combination of the two, the ultimate goal is to create a secure and prosperous financial future.